If you're running the wheel strategy with a small account, the stocks you choose can make or break your results. I'm about to show you 5 stocks that you can use for the wheel strategy. Stocks with high premiums, reasonable volatility, and very good liquidity. I'll show you why each one works, what strike prices I would use, and the one big mistake that most beginning traders make when using the wheel strategy. Let's get into it. Coming in at number 5 is none other than RIOT. If you're familiar with Bitcoin and Bitcoin mining, perhaps you've heard of RIOT. Now, what do we like about RIOT? Well, low price point for those with a smaller account. So if you're going to do the wheel strategy, it has to be affordable. At $18 per share, anyone with $1,800 could own 100 shares of the stock. And the good news is, we could make a promise to buy it cheaper. Notice the high liquidity, very, very heavily traded. The volume just the latest trading session was 25 million stock shares, and the options are very liquid as well. What does RIOT do? Well, RIOT is, as we said, a Bitcoin mining company operator. What don't we like about it? Well, the earnings are non-existent. Why don't we get a forward PE and PEG ratio and these things? And that's because the EPS is negative, meaning the company is losing money. We can't really do a great valuation when companies are losing money because we have to kind of project, okay, when are they going to stop losing? How much are they going to make? And it's a little bit more difficult game to play. You can still do some valuation metrics, but obviously we would love it if the company were making money. Number 4 on the list, we've got Open. Open operates in the real estate segment. Notice $6 stock. Anyone with $600 could own 100 shares. It traded 49 million stock shares today. Again, the options are very liquid. What does Open do? Well, it buys and sells real estate. Once again, the problem, negative on the EPS. EPS stands for earnings per share. They are losing money. Number 3 on the list, we've got Snap. If you have a teenager, perhaps they're using Snapchat. That's what this company does. Coming in at $7 per share, it would take at least $700 to own 100 shares of the stock. Concerns? Well, again, this is in a downward trend below some moving averages, perhaps coming down to this prior support level. If it breaks, if that support level breaks, we've got some problems below. So Snap is a visual messaging application. You can look at Snap's non-existent earnings, again, negative on the EPS, so they can't really give projected numbers. Number 2 on the list, now we're going to start to get to some actual earnings. SOFI. SOFI comes in at $25 a share, a little bit more expensive. You can make a promise to buy it cheaper, of course. If we look at SOFI, you can see from the description, it is in the financial services. They do lending, investing, all of the things that most traditional finance companies do. You look over here and we have some positive EPS. Now, they're not trading at bargain prices. Their PE ratio is sort of expensive, but you can see a reasonable future that at least they're earning some profitability. Coming in at number 1 on the list, LYFT. You've perhaps taken a ride share with LYFT, right? Big competitor to Uber. Now, disappointingly, the stock is in a downward trend. Recently, we would even say, has broken some levels of support. Why might that be okay? Well, we can pick it up cheap. And most importantly, if we're doing the wheel strategy, we want to see some fundamentals that we can get behind. This is a peer-to-peer marketplace ride-sharing company. So basically, people contract to give rides for Lyft. You can see on the EPS some positive numbers, and EPS next year is expected to grow by 80%. Over the trailing 12 months, their earnings grew by 324%. Their sales grew by 15%. So we can see that there's some progress being made within the company. Now, they're not trading at massive value opportunities. There's still going to be some bumpiness to LYFT. They're trading at 50 times earnings, 26 times forward PE. It's not as though they're massively discounted, but you'd have to get behind the idea that this company is going to be around for years to come, and the premiums that we can make are significant. So let's dig in a little bit more on those premiums. So if we jump over and look at an order ticket, the stock is trading lower. We could make a promise to buy it in about a month's time at a deep discount to current prices. So notice, stock price at $18 and change, we could promise to buy it cheaper. If you're not familiar with the wheel strategy, make sure you check out our other video where we talk about what the strategy is and how to employ it. But basically, we're selling a put, which is a promise to buy if it goes to a cheaper price. So we're not buying at today's prices, we're buying in the future at a discounted price. And for making that promise, we get paid premium. How much premium do we collect? Well, here we can see the premium that we're collecting is $1 in premium. That's equal to $100 if we sell one contract. Obviously, if we sold two contracts, now it's $1 times 2, so we'd make $200 and so on. But every contract you sell is a promise to buy 100 shares of stock. So here we can see that we're going to make $100 whether the stock goes up, sideways, or down. And this is where I see people make huge mistakes, is they do not have a plan for up, sideways, and down in price. Up and sideways are pretty simple in that we wouldn't need to do anything with this. We could roll up or do something to try to capture more profit for the month. But basically, if the stock's up or sideways, this put option will expire worthless and we make our $100. Well, $100 doesn't sound that great, but here's the thing. We're making a promise to buy $1,700 worth of stock, but they supplied us with $100 of premium. So we don't even have to come up with the full $1,700. Here's your ROI, and this is a beautiful thing. We made a promise to buy the stock at 17, but they paid us $1 in premium. So we have a $16 potential cost basis. Or in other words, we only have to tie up $1,600 of our money, and they paid us $100, which we get to keep no matter what. So what is $100 profit on $1,600 invested in this put, in this cash secured put? Well, that's our ROI for the month. $100 divided by $1,600 equals 6.25%. So you can make 6.25% return on your money in 1 month's time. Pretty nice return. And the worst case scenario is you get to own 100 shares of LYFT at a cost basis at $16, a steep discount to current prices. If we end up owning the stock, we can turn around and do the second part of the will strategy, start selling covered calls and bringing in even more premium. Further to the point, we want to have a plan for if it's going down. There's an opportunity to roll down and improve your cost basis further. We could roll this out another month and pick up more premiums. We always need to have at our disposal, our knowledge of the options market is what allows us to make adjustments, improve our numbers, make more profit with less risk, and that's the key to success in the options market. So don't fall into the trap and the huge mistake of not knowing what to do up, down, and sideways. That is a huge part of trading profitably. If this was helpful, make sure you watch my full will strategy system breakdown, where I go through it step by step. That's the foundation. Click here to watch it now. And if you want more than just the will strategy, you want iron condors and credit spreads and other income strategies, make sure you check out the Cash Flow Academy. The details are in the description. See you in the next video.